Howdy, y'all. My name is Ryan Finglass. I'm a financial advisor here at Beavers Wealth Management. And today, we're incredibly excited to have Bryce Gill with us. Bryce is an economist from First Trust renowned economic team. Actually, just over a year ago, they earned the 2022 U.S. Forecast Accuracy Award from Consensus Economics for delivering the most accurate economic forecasts. Now, Bryce has a wealth of experience in both the economy and markets, and today we'll dig into how these two intersect, particularly during election cycles. So our goal today is to break down what we can expect from different presidential election outcomes and how they could ultimately impact investment portfolios. Now, we want to make this clear. We're not here to pick sides. We're here to learn from the data and the facts to empower Beavers Wealth Management to make the best possible decisions for our clients. We really appreciate you joining us. We're excited to share our conversation with Bryce today. Enjoy the show. Bryce, welcome to Between the Bears and the Bulls, man. We are so excited to have you here. Thank you for taking the time. As you know, our goal with this podcast is to discuss chasing excellence, business, the economy, markets, and just about everything in between. But before we get into our discussion around the elections and the implications on the economy, I'm curious to hear your journey. So I know you started your education at Miami University, got an undergraduate's degree in economics. Then you took a little detour down to the University of Austin, graduated with an MBA. And everyone here at Beavers Wealth Management, we're mostly Aggie, so I may have to give you a little bit of a hard time about that. But I know once you graduated, you started your career with AT&T, and now you've been with First Trust for a little over a decade. So what's the story behind that path? How does one become a professional economist?
Yeah, absolutely. And by the way, I'm like kind of a weirdo in the economics world because I don't work for the government and I don't work in academia, right? So there's very few of us.
Right.
I'd say, it's like maybe 10% of economists are in the actual private sector. And so, yeah, I graduated Miami University in Ohio. Didn't want to stay in the Midwest where I'm from. I'm from Illinois. So I moved down to Atlanta. That's where I worked with AT&T for about a year or so. They wanted to send me back to the Midwest. So at that point, I had a lot of contacts at First Trust. I'd interned here. I got in touch with my current boss, Brian Westbury. He needed someone to be in-house doing Excel spreadsheets and updating slides and doing data entry and dealing with compliance. And so I sort of started at the bottom, honestly, and over the years, picked up more and more responsibility, started writing, started doing calls, started helping out the sales force here at First Trust. And ultimately, the UT graduate degree, I saw that as my opportunity to get out of Illinois for one. I always wanted to live in the South. So it got me out of Illinois, got me down here to Texas. But really, it was also a strategic move because First Trust, I think one thing that really differentiates us as a company, we're not publicly owned like most of our competitors. This is a privately held company. It's a very strong spirit of entrepreneurship at First Trust. Nobody is setting up my calls or my meetings or my travel for me, right? And so I moved down to Texas so I could build relationships in that region of the country with the sales force because, in Wheaton, there were other economists that were senior to me. They already made a lot of relationships there. I saw the move to Texas as a way to branch out, put somebody from the economics team in the South, develop relationships in that region. It's really when I started doing public speaking, getting out there more, and then COVID hit, and obviously I beat the rush down to Austin, but that's really where things went into overdrive. At First Trust, we were very strongly opposed to, government shutdowns, government mandates around vaccines, mask mandates, things of this nature. We were doing something called the COVID tracker. This thing went absolutely bananas. It was, I was writing research for the Council of Economic Advisors at the White House. I'm dealing with members of Congress. So it really showed me, hey, I'm pretty good at this, right? And here we are post-pandemic, and the world's totally changed. It's made my job more stressful, but honestly a lot more interesting. So I've had a kind of a pretty crazy path to get here. Most of it learned, in the field, on the job.
Yeah, and I think that's super interesting. One of the things that I always appreciate about economists is that y'all kind of do the dirty work. You take everything that's policy or theory or thought and run the numbers behind the scenes. Like you mentioned, you started from the bottom. you saw and looked at the data entries and Excel spreadsheets to see how a lot of these different implications or ideas could impact our global economy or our domestic economy. So that's what we want to focus in on today. Today we want to discuss some of the potential outcomes that we may see from the 2024 presidential election. But before we do that, Bryce, I want to set a little bit of a backdrop. How do the economy and markets, because again, we're investors ourselves, so we want to relate everything back to the markets. We know that there's an intersection between those two ideas, the economy and markets. Where do they differ and where do they mirror each other?
Yeah, absolutely. Well, you know, I think there's obviously going to be a general correlation. So, you know, if your GDP is going up, for example, right, that means there's more people around, those people are getting wealthier, they're going to have more money to spend. If you're a company that has publicly available shares, you know, you're obviously going to have more revenue, you're going to have more earnings, right? So the growth of the economy overall, over, you know, medium to long term, should sort of mirror the stock market, okay? But what we can see is for short periods of time or due to like certain changes in government policy or especially Fed policy, right? Interest rates go up, interest rates go down. You can see policies that, you know, benefit the markets over the real economy. So a really good example of this, for example, it would be like after 0809, okay? It was a terrible recovery for the real economy, but the Fed was printing money like crazy. It was great for assets, right? COVID-19, economic disaster on a global scale, but what does the Fed do? They cut rates to zero. Markets do a V-shaped recovery and are back to record highs much quicker than the real economy, right? So there are ways to short-term see a big gap open up between the real economy and the stock market, but I'd say, you know, medium to long-term, they're pretty well correlated with each other.
Yeah, and I think too what's important to know as well is that if they mirror each other long-term, for the most part, there's a strong correlation between the two. Two big areas of policy, fiscal policy and monetary policy, can both have a large impact on the growth of an economy. So I also want to set another divide before we get into this conversation. Bryce, can you help me understand better the differences between fiscal policy and monetary policy? How are they established and how do they interact to influence our economy?
Yeah, absolutely. So fiscal policy is going to be government spending, basically. It's the checks that the federal government is writing. Okay, so when Congress gets up there and they pass the CHIPS Act, for example, this, you know, is about like $1 trillion in subsidies to bring semiconductor manufacturing back home. So the government actually writes a check, they send that money to Intel. Intel then decides to build more semiconductor plants domestically. Okay, so fiscal policy is going to be direct government spending for the most part. So when you hear about like the deficit or the debt, that's typically a result of fiscal policy. Monetary policy is really going to be mostly about interest rates. Okay, so it's going to be where the Federal Reserve sets the federal funds rate. And the federal funds rate is basically the benchmark interest rate that every other interest rate in the economy is built off of. And so, you know, the easiest way to understand monetary policy high level, especially as like a consumer or somebody that'd be watching this podcast, is that we speed up or slow down the economy by raising or lowering interest rates, and people will have more or less money after interest to buy other stuff. So that's the easiest way to think about monetary policy, I think, for a normal person.
Yeah, that's interesting. And I would say this too. Right now, the timing of this podcast, you know, we're in October of 2024. We're about a month away from the election. We just saw the Fed start their rate cutting cycle. It's an interesting period of time to both kind of dissect monetary policy and fiscal policy. And I think, you know, us as financial advisors, we often get asked questions about what do we think is going to happen in the future. And I think people sometimes assume, for lack of a better term, that we have a magic 8-ball or a magic wand to kind of predict the future. And Bryce, the truth is we don't. I think it's human nature to want to know what's going to happen before it does happen. While we can't predict the future, Bryce, we definitely can go back to historical data and look and see if there's any patterns or similarities that occur over time. So as we look back at history and kind of transitioning this now to talking about elections, historically, how do election cycles tend to impact markets, would you say? Is there a clear pattern that you could go back and look at years like 2020, 2016, 2012, and so on, to see if there's any patterns that kind of amount in election years?
Yeah, so we've done a ton of empirical testing on this, and basically every other, by the way, Wall Street investment firm has done this research too, because every 2 years or every 4 years we sort of have this discussion. And I know we turn on like Fox News or CNN or CNBC, and it's going to be really heavily focused right now on the differences in policies between these candidates and the economic impact they'll have. And I think it's interesting to talk about all that, and we're going to do that today on this podcast. But investors at home need to know that over the past 100 years or so, you look at whether a Democrat or Republican wins the presidency, the differences in outcome are basically extremely small. Now, I mean, I could maybe find like a 1 or 2% difference in returns if I really torture the data. But big picture, I'd say it really doesn't matter that much. I think this stuff is high drama, low impact. What we've found to be much more important, and we've kind of ran the data, so say like you put $10,000 in the market, okay, you can either do that under Democrat administrations only, Republican administrations only, or under both. Okay, the differences in returns, I think at $10,000 after 50 years, you're like $160,000 under Republicans, like $180,000 under Democrats, and it's more than double, right? It's like $450,000, $500,000 under both administrations, right? So what that tells you is it would be very, very foolish to invest just based on who's in the White House. And I think that's good advice today, just like any other period of time. I know, obviously, it's always the biggest, most important election of our lifetimes. But generally speaking, what really drives the economy and drives markets are fundamental factors like demographic growth, how many people are going to be around, and productivity growth, which is like entrepreneurship or innovation. And so government policy can certainly affect like innovation, right? You could put a ton of regulation as like a wet blanket on the economy. And I think we do that, by the way. And so, yeah, maybe deregulation under Trump would be maybe baseline a little bit better than under Kamala Harris, right? But generally speaking, the returns in the market are not drastically different between a Democrat or Republican.
That's interesting, and we'll get to this a little bit later in today's discussion about how some of the different sectors may see a different outcome depending on who wins the election. But before we get there, again, kind of going back throughout history, we've been through some I mean, quite honestly, some pretty crazy election cycles in terms of where the economy stood during those years. So if you go back to 2020, obviously we were dealing with COVID. You go back to 2008, we had the Great Recession that we were trying to navigate our way through. We've been through a lot of difficult economies during presidential election years. And so I'm curious, Bryce, how would you say where would you say our current economy stands today, if you had to give it kind of a rating? But then two, how much does the current economy, what situation we're in economically, do you think that has a big impact on the policies that are talked about during campaigns, or just in general? Do you think it has a big impact on the election outcomes?
Yeah, so if I was going to characterize the economy right now and give it sort of like a grade school, letter grade here, I guess I'd give it sort of a C. We've had a really strong past 2 years, and the reason why is we've had a reopening boom. Okay, the 2 years during COVID were really bad. Then we locked everybody inside, we gave them free money, and we let them back outside. And so, hey, the past 2 years we've sort of boomed as we reopened. But the reality is, here today, people have spent through their excess savings, their interest costs are higher, job gains are slowing down. It just looks to me like the reopening boom is sort of tapering off here. And you add to that, the government has massively expanded in the aftermath of COVID-19. And, my view is the government is just way too big. You look at the size of the federal government as a percent of GDP, it's basically the highest it's been since World War II. Now, if the government was out there spending money on, let's say, nuclear power plants being built all over the country, or like really high quality infrastructure, maybe there'd be a big payoff from all of that, right? But it seems like most of this money is just getting completely wasted. It's not like we've solved homelessness. It's not like we've solved, poverty. It's not like we've, made the world completely safe. Everything's kind of more chaotic. And so I think there needs to sort of be a reckoning in the United States and realize, hey, we can't just keep throwing money at everything. It might have worked at 0% interest rates. It's really not a downside. At 5% interest, the whole budget's going to get taken up by interest costs at some point. And so it's really created a huge issue for the country. So I think there's an opportunity to fix a lot of that. And by the way,
Yeah.
medium to long term, we have a lot of investment coming back to the United States because we're by far look the best place to invest right now. And you look around the world, Europe's a disaster, China's in an economic downturn that's probably going to be ongoing. So I think we have a lot of sort of medium to long term advantages in the United States. But short term here, I do think we're hitting a speed bump, and government policy is not helping with any of that. So what was the second part of your question there, Ryan? Sorry, I went on a little bit of a tangent there.
Yeah, no, and I think that's great. I think it's interesting because it's one of the things that we talk about a lot with our clients on a daily basis is that you're right. We've seen inflation start to come back down. Interest rates are starting to get cut. But if you ask most people, it's still not, they don't feel like we're in this great economic period, even though some of the data, if you're just to look and say, okay, inflation's coming down, interest rates are getting cut, it doesn't necessarily feel like that. So I think it's interesting. And the question was, Bryce, based on where we're at, kind of that C grading that you gave us, would you say that the current, situation of an election, the current state of an economy, do you think that has an impact on presidential elections? Again, going back to years like 2008, do you think that, given that we were in the midst of the Great Recession, do you think that had a strong impact on not just the policies that were talked about, but election outcomes? Do you think people wanted change to see change? Do you think that's something that we're sitting at today?
Yeah, no, you go back in time, I think this question's been sort of asked or widely polled since the 1950s. And the question's very simple. It's just, do you feel, like you're better off than 4 years ago, right? So maybe a way to think about that is, hey, is the economy or like society advancing, or is it sort of hitting a wall here? And I think a lot of people, we're in the midst of the COVID pandemic under the Trump administration. The world had kind of fallen apart. Well, it's very difficult for the incumbent to win under those conditions, right? Most people want to change
Right.
if things are really bad or if they're worse than 4 years ago. And so, are things better than 4 years ago? They are, right? I mean, we're not in the depths of a pandemic. We've recovered a lot, but at the same time, we're dealing with a lot of inflation. People feel like their dollar's going, less far than it used to, which of course it is. And the economy is certainly not in this turbocharged recovery anymore. And so it's a little bit easier to make the case, hey, we're better than we were 4 years ago, but the economy doesn't feel great either. And so I think, by the way, this is why the polls look so close right now. It's basically a dead heat, right? So
Right.
I think it is going to be, and by the way, there's no incumbent running, right? I think this is sort of a genius move that the Democrats pulled, getting Joe Biden out of there and replacing him with Kamala Harris. Of course, Kamala Harris was part of the last administration, right? She's the vice president.
Right.
She's able to kind of write that off and be like, hey, that was Joe Biden. And so I think it's given us a much more close race here.
Yeah, and I think, too, given that we don't have a true incumbent, obviously we've had 4 years of a Trump presidency and we've had 4 years of a Biden-Harris administration, but there's a lot of new policies that are being talked about. And so, Bryce, I want to talk policy now because we talked about this. The economy, even though the numbers are showing that we're not in the best spot, but we're certainly not in a terrible spot, it still doesn't feel that great. So policies, I think, are of high debate right now because we can look at it and sit back and say, okay, which policies do we like better? Which policies do we think will have the biggest positive impact on the economy moving forward? So, Bryce, again, I think this election cycle definitely feels very emotionally charged. We've got voters on both ends of the spectrum, deciding what policies they would like to see, and everybody feels very strongly about where they would like to see the election head. And quite honestly, I think, too, there's a lot of noise out there, right? And it's not an easy task to block out some of that noise. So as we head into this election cycle, Bryce, as an economist, what do you think are the key factors or policies that investors should be paying close attention to?
Yeah, so I think from an investor's perspective, there's kind of, I guess I'd say three major ones. Okay, there's going to be the corporate tax rate because that affects earnings, obviously. It's going to be immigration policy, which I think is going to have an impact on inflation rates. And, basically whether or not the Fed's going to be able to keep cutting interest rates like they have been, which the market's really enjoyed. And lastly, I mean, we could maybe talk about the capital gains tax being raised and maybe even taxing unrealized capital gains. This is sort of the biggest revenue raising policy prescription that Kamala Harris has. And so, corporate tax rate, this is very simple. Okay, Donald Trump wants to get in, he wants to cut it further, right? So it's pretty low from a historical standpoint. Currently, it was part of the Trump tax cuts to lower it, in line with a lot of sort of other countries around the world. He wants to take it even lower to about 15%. Short term, that would be good for markets, right? It just means companies are paying less taxes on their earnings. So I think markets would like to see a lower corporate tax rate. Kamala Harris wants to raise the corporate tax rate, right? She wants to raise it to about 28%. By the way, not sky high. It would still be lower than most of my lifetime, right? So I do think that would, though, short term, it would be sort of moderately bad for markets. I think currently markets are pricing in a lot of rate cuts from the Federal Reserve, a terminal rate of 2.7%. So we're talking about over 200 basis points of cuts to come still. And so I think that really relies on the Fed seeing the inflation rate continue to fall towards their 2% target. And so that kind of gets me to immigration. I think immigration policy, specifically illegal immigration policy, is the biggest difference between these two candidates. Kamala Harris is obviously a little bit more status quo. Currently, we have about 3 million people crossing the border illegally in the United States, or at least that's the best data I can find. That's as many people that come legally every year. It's the highest level of illegal immigration in U.S. history. What that's done, especially over the past 12 months or so, is it's added a bunch of labor into the U.S. labor market, right? So you can think of it this way, like a domestic employee has to compete with more people. They can't really demand as big of a pay raise because the business can go out and just hire somebody that just walked into the country, right? And so I think that's helped get the inflation rate down. It's helped slow down wage growth. You remember, like during the pandemic, there were more job openings than unemployed people. Immigration was zero basically for 2-3 years. Chipotle used to pay $12 an hour. Now they pay $20 an hour plus like pet insurance and emotional health days and whatever else, right? It's like a 100% increase in compensation in 3 years. That's going to have an impact on inflation.
Right.
I think illegal immigrations help offset some of those wage pressures, okay? If Trump gets in there, he's able to crack down on illegal immigration significantly, actually execute on a border wall, actually reduce the flow substantially. What it's going to do is it's going to empower domestic labor. They're going to be able to essentially negotiate higher wage increases, okay? And by the way, this has been a big theme over the past couple of years that not a lot of people have talked about, which is labor negotiating power has made a comeback in the United States. We see it today, by the way, with the port strike, right? They're choosing right now to make a move because they have a lot of political leverage. And, domestic labor has got more power because we don't have to compete with everyone around the world as much anymore with the reshoring boom. So I do think Trump cracking down on illegal immigration, it probably adds a little bit to the baseline inflation rate, but it does that because normal people are seeing their pay go up faster. So it's hard to call that bad or good. It's just, it is, right? It's a trade-off.
Right.
And obviously if inflation starts to rise again, it's going to make the Fed's job of cutting for the next 2 years a lot more difficult or like politically uncomfortable. The last thing we'll talk about here is the capital gains tax. So again, this is the largest revenue raiser for the Harris administration, along with maybe raising a couple other corporate tax rate, things like that. Capital gains tax, I believe she's proposing like 43% capital gains. So that's below what Joe Biden was proposing, which was around 50, which was the highest in U.S. history. She's kind of scaled that back a little bit. It's still very high, though. It would obviously be short-term bad for markets if we all have to pay higher taxes on the capital gains that we make. But really the scarier part of this proposal, okay, and the one that has no chance of passing, but I think is worth talking about, is taxing unrealized capital gains. So this would be for very wealthy individuals, is my understanding, people that have over $100 million in wealth. The problem is it's very difficult to administrate, right? It's also, by the way, probably unconstitutional to tax someone's wealth. We've never done that before in the United States. And so most people that have over $100 million in wealth, Ryan, don't just have like Vanguard index funds, right? There's a
Right.
lot of privately held assets that are
Yeah.
very illiquid. And so, how do you really tax that? Very unclear, right? If you're a founder of a company in Silicon Valley, you're still generating losses as the company's growing. So, the
Hmm.
value on paper of your business is going up, but you're losing money every single year. What do? You just raise even more money from investors to pay the tax on the capital gain. It seems to me it would basically destroy capital formation and entrepreneurship in this country. I think it's one of the worst policies I've ever heard of.
Wow. And see, Bryce, this is why I think it's extremely important to have these kinds of discussions around policy, because as an economist, fundamentally, you have to break things down and see what the long-term, medium-term, short-term impacts of some of these policy changes are. And I think a lot of times, a lot of voters, even investors ourselves, will just look at the headlines and say, okay, lowering corporate tax rate, that sounds good. When you do the numbers and you go underneath, you can actually see how that would play out, right? Or vice versa, you look at another policy and say, hey, yeah, it sounds great on paper, but once you run the numbers and you do the math behind the scenes to see exactly what the implications are, it may not work out the way that you necessarily thought it would. And so I think, especially as you had mentioned earlier, we're at this point right now. We're about a month away from the election, and we're at a dead heat, at least according to the polls. And so that suggests that we could see basically anything. We could see a full Republican sweep, or we could see a Democratic sweep, or any of the combinations in between there. And so I think it's important then to drill down on policies, because each policy could mean different things for different sectors of the markets, right? And so are there any different sectors that you see are highly sensitive to this election? I think about energy sector, technology sector, healthcare. What areas of the market, if you dive in a little bit deeper and just kind of say, okay, let's take the 11 sectors out of the S&P 500, what areas do you think are most at risk for further volatility going into this election?
Yeah, so there's obviously the traditional sectors that sort of lean Republican or Democrats. Like oil and gas is obviously going to
Hmm.
benefit if Trump gets in office, right? I think you'll see oil and gas prefer a Trump administration. Um, Conversely, electric vehicles, green energy are going to benefit from a Kamala Harris administration, right? They're going to keep giving out the same subsidies where Trump's talking about cutting a lot of the subsidies. So I think you'd
Right.
see a difference, obviously, green energy versus like traditional energy in this election. Tech industry. Uh, it's really hard to say on tech. It seems like the Democrats are much more protective of the tech industry. I think they receive more donations, so I understand that. But there's been a lot of talk of regulating tech, a lot of talk about regulating social media companies. I think that's more likely to happen probably under a Trump administration. He obviously
Mm.
already feels like he's been targeted by some of these major social media networks. And so I think maybe Republicans would probably be more open to putting some regulation down on these companies. Defense, I don't see a huge difference in defense spending between the two candidates. I think either one, it's kind of the defense budget's going up, right? And so, you know, other than that, those are kind of the biggest headline beneficiaries of the two candidates, right? I guess you could talk like pharmaceuticals. They lobby a lot. They seem pretty bipartisan. So the biggest to me is probably oil and gas versus green energy.
Yeah. Yeah, and that's interesting too, because I think we've seen a lot of changes recently. You talk and you hear some of the things coming off the campaign trails where I would say that the two candidates are more so, even the Republicans on the right, which you would think are traditionally in favor of oil and gas. You've heard Trump speak with people like Elon Musk saying, hey, the transition to clean energy is something that we definitely want to see long term, but we may have to wait a little while for us to kind of get there. We're not quite there just yet. But another area too, Bryce, that I want to look at as well is trade. And from a economics 101 class standpoint, we see two very different sides of the table when it comes to Republicans or Democrats. And I really want to help. I want you to help me explain, and that way I can better understand. Say you take on one end of the table Republicans, right? Trump has talked about increasing tariffs on countries, say like China, to almost 60%, 10% tariffs across the board. on the other side of the table with the Democrats, they're more likely to subsidize different sectors of the market to help boost production. Where's the line between those two? How do those two ideals kind of impact the economy long term? Subsidies versus tariffs to increase production?
Yeah, so a subsidy is basically, hey, the government's going to write a check to incentivize like a specific industry to come back home, right? So it's going to be a little bit more targeted, and it's much more like picking winners and losers, I guess you could say, than a tariff, which is just a more blanket policy, right? And so, what tariffs do, and there's been so much debate over tariffs, like who pays it? Do the Americans pay it? Do the Chinese pay it? Right? So I get all of that. A tariff is a tax. Okay, we're basically adding a tax on imports, and by doing that, we make those imports artificially expensive, which incentivizes consumers to potentially make a different decision. So if like an American producer makes something for 25% more than a Chinese producer, if you add a tariff on the Chinese good of 25%, now a consumer looks at these two products and they cost the same, right? So what that does, big grand scale, is it incentivizes companies to bring production back to the country to avoid the tariff, right? And so, I think kind of what's interesting here, and you're absolutely right, the Democrats are doing this in a different way. We call it like industrial policy is what the Democrats are doing versus tariffs. Okay, what's really interesting here is they basically come on big picture to like the Trump platform of 2016. And this is one thing I find really, really interesting that nobody really talks about. Like back in 2016, Donald Trump was the only one talking about bringing business back home, about supply chains, about any of this stuff, right? He starts a trade war with China. He adds all these tariffs. By the way, none of that crashed the economy. It probably wasn't, made things more expensive a little bit, but we're talking a pretty small increase in inflation. It did raise a bunch of revenue too. But then ultimately COVID hits, right? And all of a sudden you can't buy baby formula and toilet paper. Now everybody agrees that we need to bring certain aspects of the supply chain back home, right? So my biggest, I guess, critique of tariffs here would be you need to do more targeted tariffs, okay? I prefer like a tariff to an explicit subsidy. I think it's, by the way, better for a government budget too, okay? But, if you just put, for example, Trump wants to do tariffs of like 10% on every good from around the world, right? Or 60% on every good from China. The problem is certain industries, right, will come back home. Like semiconductors will come back home, okay? Or green energy manufacturing will come back home. Or pharmaceuticals will come back home. If you add a 25% or a 60% tariff to, let's say apparel, clothing, right? There's no amount, there is, I guess, a certain level of tariff that you could get clothing manufacturing to come back home at, or like furniture making to come back home at. But, it seems to me to be, inefficient to expect Americans to make all their furniture by hand again, right? The reality is we're a very advanced economy, a very advanced country. We have a high level of like expertise in advanced manufacturing and services and financial services and entertainment, and we've sort of like carved out our niche in the global economy. We're just not going to start making our own clothes again. I find that very unlikely, right? I think the way we need to do tariffs, which again, I prefer tariffs to explicit subsidies personally, okay? I think the way we need to do that is target them better. So you would tariff electric vehicles, you would tariff, green energy products like solar panels and windmills, you would tariff semiconductors, you tariff pharmaceutical precursors or pharmaceutical pills. That's a kind of a better way to do it than just a overall scattershot move here.
Yeah, that's really interesting, Bryce, because I think, again, that's why this conversation is a lot of fun for us to listen to, because you got to go through, you really got to take the time to kind of dive deep into some of these topics and say, okay, exactly, yeah, it makes sense that setting tariffs on China would bring industries like semiconductors back here, but we're not going to see furniture building make its way back to the U.S. That doesn't sound reasonable or logical. But Bryce, I want to understand too, because like we mentioned earlier, it's very tight race. And I know your team at First Trust, y'all spend a lot of time looking at the numbers to see exactly what are the best. Essentially, where do the numbers tell us we can make our best decisions moving forward, given with the information we have at this time? So, as of today, about a month ahead of the election, what does your team see as the biggest likely outcomes from this election?
Yeah, we're in a dead heat. We kind of already talked about that. Or I think like Kamala Harris might have like a 1 or 2 percentage point lead in the polls here. And so what's really interesting about this election and what kind of helps me as a forecaster is Donald Trump has now been a candidate for 3 elections, right? So you can kind of go back and look at those previous elections and get sort of an idea of what might happen. And when I do that, when I look at his race against Hillary Clinton and his race against Joe Biden, what you see consistently is that Donald Trump outperforms his polling by 5%, 6 percentage points, okay? So, he obviously beat Hillary Clinton and surprised everybody. We all remember that. Joe Biden, I think what people don't remember about this Biden election, and there's obviously a lot of controversy around it and people remember certain things about it, but what people don't remember is that Joe Biden was leading Donald Trump in the polls by like 10 percentage points, or maybe a little bit less, 6 to 10 percentage points that entire election. And we already mentioned it, Ryan, right? It's like, do you feel better than you did 4 years ago? There's a global pandemic. It's literally the worst possible environment to run for re-election under, okay? And so,
right.
Hey, he lost the election, okay, at least officially. And that being said, though, he didn't lose it by very much, right? He outperformed those polls pretty significantly. And so I think today, if Kamala Harris goes into election day with like a 2% polling lead, she probably loses to Donald Trump. That would be my guess. So if the election happened today, I think Donald Trump would probably win.
Wow. And again, for all the different things that we talked about earlier when it comes to the different policies, that would mean a different side of the table when it comes to the election outcomes. But I want to tie this back into markets, Bryce, as we start to wrap things up a little bit. Obviously, there's a lot of noise out there, but as investors, we always have to keep a long-term perspective. So as a long-term investor, how do you balance election noise while trying to keep market fundamentals at your core decision-making?
Yeah, I mean, I guess for me, I have like economist brain, right? So I've seen like all the different numbers like so many times that for me, I look at elections, it's sort of an interesting thing to think about and look at the different policies, but I don't see them as highly relevant to outcomes in the market over the long term, right? And so, yeah, I just go and look at the normal fundamentals that we all look at. I think those are more relevant here. And when you look at the fundamentals, what they tell you is, hey, the market, maybe it's a little bit frothy in valuation in certain sectors, especially like these big tech companies or like the Magnificent Seven. And that's changed a little bit over the past quarter, right? Those stocks have had a bit of a correction and we've seen breadth widen out a bit. But, you look at the different sectors of the market, there's certain things like small caps, mid caps, like value, these sort of like cyclical areas that need to catch up, or the really high flyers need to fall to make the market look a little bit more well balanced. And so I think what's going to happen here, now that we're in a cutting cycle from the Federal Reserve, I think those cyclical sectors are going to have a bit of a rebound here, and that's exactly what's been happening over the past few months. And so I think look for some of those less loved sectors to outperform the really high flying like Magnificent Seven here over the next year or so. Ultimately, I think the biggest risk to the market is whether or not the Fed can keep cutting interest rates or not. I think right now, a lot of rate cuts are priced in. If the Fed can actually execute on all these rate cuts, if we get to a 2.7% Fed funds rate in 2026 or whatever, the market where it's at today looks fine to me. Like, it doesn't look necessarily very overvalued, especially if like Trump can execute on a tax cut for corporate rates. The market might be even a little undervalued, right? If, though, the Fed can't execute on all those rate cuts, if inflation stays hotter than 2%, if we don't have really a recession to give the Fed an excuse to keep cutting, which, by the way, this morning we just got data on employment, right? It came in way better than expected. So, like,
right.
Where is the justification today? The economy is still pretty strong. Inflation is still too high. there's really no reason for the Fed to be cutting at all, in my opinion, but they are, so that's good for markets. Does that justification last, though, into 2026? It's hard for me really to see that. And so potentially Kamala Harris gets in there, raises corporate tax rates, and on top of that, the Fed has a very short rate cutting cycle. That could be trouble for markets right there.
Yeah. Wow, Bryce. Well, thank you so much for joining us today, man. There's a lot of good stuff that we went through, and I think most importantly, thank you for allowing us to pick your economist brain a little bit today, because it really does help. As you go through some of this, like we said, there's a lot of different things out there to try and navigate your way through, both from a voting perspective and an investor's perspective. But really today, thank you for your time, Bryce. We really appreciate it.
Absolutely, Ryan. Hey, it was an honor to be with you guys, and hopefully we'll do it again sometime.
Yes, sir. You got it. Thanks, Bryce.
See ya.
Man, what a conversation with Bryce. That was a lot of fun. I think it's so important in years like this, and especially around an election, to really look at the fundamentals of how an economy works. And I think that was what was so interesting to me talking to Bryce, was we broke down a lot of the different policies that are talked about from both candidates. And I think that is one of the things that you have to do whenever you're an investor and trying to anticipate what the different election outcomes could potentially be. So for me, what really stood out, Christopher, is the way Bryce broke down fiscal policy versus monetary policy.
Yeah, that was interesting.
Yeah, and I also think, too, setting that backdrop and saying, hey, First Trust, we've done the research, we've ran the numbers, we've looked back historically to say, okay, if you were to only invest during a Republican presidency or vice versa during a Democratic presidency, in the long run, if you were just to stay invested through both of those periods of time, there may be a slight edge to one side or the other of the table, but long-term market fundamentals, interest rates, monetary policy tend to kind of set the road forward more so than talking about policy changes from different presidential candidates.
That was eye-opening, right? I mean, when they showed you and he talked about, okay, that $10,000 would have been 160 or 180 if you just invested with one particular party, but was it 480,000? I mean, it's something mind-blowing if you just stayed the course throughout that period of time.
Yeah.
And I think it's important. I mean, especially as we deal with this every 4 years, we obviously have we hear it from our clients, the same concerns of, what if this person wins the election? Does this mean that the whole market's going to go to hell in a handbasket, right? Or what if this side wins? And I think what was so powerful from that was just the reinforcing the idea that over time, the presidency really doesn't make a huge difference as it relates to markets.
Yeah.
And even though there is correlation between markets and policy, it's not a perfect correlation, right? And so that to me was pretty interesting. I love what he said too, where that was unusual that we got to sit with an economist who wasn't in academia and didn't work for the government.
He was a TU. Going back to A&M.
Exactly. Yeah, we're
Texas University of Texas at Austin.
We're going to let that part of it slide.
Yeah, we'll let that slide. But that's interesting, because I think a lot of times too, when you just listen to the news at night, and you, especially again going back to this being an election year, there's economists that do the numbers too, and they'll come on and say, hey, here's what we think the potential outcome is. But like you said, most of them are public employees.
Right, exactly.
Bryce is private, so his perspective is a little bit unique in that sense, to where he can really kind of take an unbiased approach and say what's best for markets long-term, or the economy long-term as an investor, as we're all players in this area.
I thought it was really interesting too when he was talking about how certain events that you would think were very negative in the economy ended up turning to be positive for the markets, right? So when you look back at 08, 09, and he was talking about, well, because that ultimately created this 0% interest policy for the government, that was actually great for assets. That was great for the markets.
Right.
You look back in 2020, same deal there, right? Which created a ton of new money being flooded into the system, actually great for markets. So that to me was interesting hearing about that, because you always think about those instances being very negative for markets, but really what it creates is potentially a solution that we saw markets go the opposite way, right? And we're sitting today at, almost all new highs in markets, and, we're sitting here and it doesn't necessarily feel like the economy is great, but yet the markets are at all-time highs. So I think that's also an important thing that I take from this, is that a lot of times we have to make sure that we look at it as financial advisors. we have to look at it from the market standpoint, right? And a lot of times what you hear on the news is more of the economic standpoint, right? Because that's what people kind of see and understand.
And not
really
everybody's an investor.
No, exactly right. Exactly right. And so understanding there's that differentiator that we need to make between the economics of things and looking at it from a market perspective, I think that's important, especially in our role as advisors, right?
Definitely.
And so that was interesting. I mean, he said a lot of kind of stuff. I took notes of, pages of notes as I was sitting here going through it. But, he talked a little bit about demographic growth, which I thought was kind of interesting too, because I know this is something we've talked about before. And that's something that at least I'm a bit concerned about, right? When you look at it just globally, when we've talked about demographic growth, that's one of the areas where you're not necessarily seeing the same kind of growth just in people as we've seen in the past, right? And so that's obviously what continues to drive markets and economy, is making sure you're replenishing, obviously, the society. And so that's something that I have always kind of looked at and would have loved to learn a little bit more about what he's seeing, because I know the United States, I believe, is one of the few countries in the world that still has positive population growth. Just it's a little bit, but it's not like what you see in the rest of the world where it's a declining population growth.
Right.
So kind of interesting.
Yeah, and two, I think, what stood out to me aside from fiscal policy versus monetary policy was going through the actual policies that are being talked about in this election cycle and kind of putting them on two sides of the table. And again, picking Bryce's economic brain to say, okay, I think you got to always go back to the fundamentals. It's what we do here at Beavers Wealth Management when we make decisions. We look at fundamentals first. What does the data tell us? What do the facts tell us? How can we use that information to empower our decision making? But same thing from a voting perspective, right? Yeah. Let's put these two, put all the noise aside, and let's just look at policy versus policy. How does subsidies versus tariffs affect our economy? And kind of doing that through these different areas of policy that we went through during that conversation, I found that fascinating.
Yeah, I mean, it's really interesting because a lot of times we don't really get to policy discussions, right? I mean, because everything is so emotionally charged these days where it's hard to actually peel back the onion and say, okay, what are the true effects of each of these things?
Right.
I really enjoyed that. But one thing I did write down here, I don't know about you, but I don't ever like to think that when you're thinking about grades, he graded the economy as a C. You know what I mean? You got that? And
do you agree with that?
I think that looking at what he's talking about, I do kind of agree. At this particular point right now, the markets aren't a C. The economy is a C.
Right.
And I think once again, that's the difference, right? And I mean, just look at it. The economy, you go around, you talk to anybody, things are out of control expensive, right?
Right.
People are having much more difficulty today buying goods because everything is much more expensive. So I do believe that we may be passing, right? And I think that's kind of what I see with the C, right? We're passing, but we're not seeing that exceptional growth that we've seen.
We can still get to an A.
We can still
plus.
get exactly.
That's what we talked about. We're not by any means in a bad spot.
Right.
We talked about the jobs report coming in just now. It was
really
great.
Good.
Yeah, it's positive information.
Yeah.
But there's still some tweaks or changes that could be made to improve. And I think that goes back again to being an investor, right?
Yeah.
From this conversation, you take, okay, there's a lot of potential outcomes, but what could I be doing today as an investor? Say you're somebody that just retired, you've got $500,000 in your portfolio that you just rolled over from your company's 401k into an IRA. Mm-hmm. You're managing it yourself. I mean, from that investor brain, what do you take away? What's something that you would be advocating for after a conversation like this?
It's a great point. I mean, I think the idea is active management is such an important part of what we're seeing today, because as he went through, I mean, he said, all right, you look at the different sectors that would do well under different regimes, right? And I think that's what I've been telling clients over the course of the last year is no matter who wins, there's going to be opportunities within the marketplace for you to invest to make money, right? And the idea is you've got to have that active approach. And it's not so much just making a decision based upon what's happening, but it's being proactive. Mm-hmm. And I've always espoused this in the way that we invest for clients, is that we're making judgments and investment decisions based upon where we see things going, right? And so being proactive with your portfolio makes a huge difference, especially in times like these, because that active management piece is something that can be a real differentiator in a portfolio. So,
yeah.
And I love to hear what he was talking about when he got through each specific sector and he went through and said, okay, this is what we think, what it would be for tech, or this is what energy would look like, and here are the places that you'd want to play.
Mm-hmm.
That requires active management, right?
Yeah.
You can't just buy and hold and leave it there and hope for the best.
Yeah. What else stood out to you, too? Is there anything else throughout that conversation?
I mean, the three key factors I thought were really interesting. The corporate tax rate, huge, right? Interesting to see that what they're talking about, obviously with corporate tax rates being as low as they have been right now, that the Trump administration is actually talking about going lower, right? And so going to 15%. And so that's interesting. I do think that I would have liked to know a little bit more from his standpoint. Okay, how do you generate additional revenue then if you're reducing the revenue associated with a lower tax rate, right?
And that's one area too that I would have loved to ask him about. Some of the other policies that have been talked about on the campaign trails. No tax on tips has been a big one.
Yeah, exactly.
A lot of the policies that sound great, again, going back to Bryce's, economist background, how do these things, like you just said, like if we're going to be cutting taxes, where's the revenue going to be to kind of fill that shoe? So another one that's big too for our industry, Social Security tax, right?
Oh,
Trump has proposed no tax on Social Security. I mean, when we go through financial plans with clients, that's something that can make a huge difference on people's feasibility to achieve their goals. I mean, if Social Security is a significant source of income for somebody in retirement, that can make a big difference. I wish I got the chance to ask him that question.
Yeah, there's so many good things to take from this, and actually things I'm going to go back now and kind of look at, because some of these issues I didn't even realize kind of were on the forefront of the discussion, and kind of looking at what that would mean for policy moving forward. So when I said the three key factors, corporate tax rate, which I think is something we got to look at, obviously going to what Harris is suggesting at a 28% corporate tax rate, which he said, which I found interesting, still well below
historically lower than what
at the 28%.
He's seen most throughout his career.
It's exactly. So that was interesting. Obviously, immigration policy. I thought that was an interesting point that he was talking about. But empowering domestic labor. I mean, this is really at the forefront of discussion based upon what we've seen this week, obviously with the the shipyards and the ports and that. So interesting I've not heard it from that perspective where you think about some of this illegal immigration that's happened, that actually has an effect on domestic labor negotiations, right? Because you say, okay, you know what, you don't want to do it I don't want to do this particular job for this amount of money. Well, we've got 20 million new people here that we're going to offer that job to at a cheaper rate. Yeah. And so it makes it more difficult for the individuals that are here to negotiate salaries because you've got that influx of people. I'd not really thought about it from that perspective. Yeah. And so that was a key thing that I took away.
And I hadn't thought too, because we talked, going again to policy, we talked about tariffs, right? Right. We started this conversation with that. But going through and saying, okay, you would expect jobs or industries like semiconductors to come back to the States. You may even look at auto manufacturing in some cases. Right. But then there's those other areas where you're not going to see large clothing factories pop back up or furniture building factories pop back up. You may see a little bit of that. Yeah. But I think some of those tariff policies affect different sectors more, are more sensitive to something like that, which is just something that was fascinating to me to listen to.
And I actually want to go back and look at it when we're talking about the tariff side of things, because I think he made a great point where he was talking about more targeted tariffs. Right. Right. So this idea of really honing in on the industries that we want more local production, right? And domestic production. And it's not the clothes, it's not the furniture, it's not that type of stuff. It's when you have a COVID-19 pandemic and you can't get baby formula and, chips, so you can't essentially have anything. Those are the kind of tariffs that I think is interesting to kind of truly target. Yeah. But not for what we're thinking as a, mass producing, just tariff everything that comes over, because, well, then to your point and to Bryce's point, we're not going to start making clothes here, right? I mean, there are other things, and we found our niche of what's important. Yeah. So, and the last thing that he talked about on those three key factors, the capital gain tax rate. I mean, that to me is obviously
makes a big difference for us.
Big difference. Yeah, big difference for our clients. I mean, this is something we are looking at and studying every day. You know, my dad is a CPA, obviously, on the team. This is something he is constantly reading about and wondering how in the world we would do this. And so
maybe we need to do that for next Between the Bears and the Bulls episode.
Yes.
Have a CPA come on and let's dive into tax policy.
I don't think anybody would watch it if that were the case. We may be the only ones that find that interesting, or my dad, but I don't think anybody else would watch that podcast. But I do think that was an interesting point as it was going through and talking about the unrealized gains.
Yeah.
And I didn't realize that Biden was suggesting a 50% capital gains tax rate, and Kamala Harris's campaign is at 43%. So that's a defining difference there. And so I enjoyed going through the policy aspect and him talking about the key factors of this particular election, because I just find it so hard these days to be able to turn on anything and actually hear really the meat and potatoes of things, right? It's
cut out all the noise. It's tough.
Yeah, it's tough. And hopefully we were able to do that, you know, today in this discussion with Bryce. Is now people can go back and say, okay, I have a few pieces of information now as it relates to what it could mean for markets and my portfolio, and looking at what we're, you know, getting ready to encounter here in 30 days. So
it's only 4 weeks away. It's around the corner, man.
It's crazy.
I think we're prepared from an investment standpoint.
Yeah.
For the next 4 weeks, and then also going forward. But we're ready for November 5th. It's going to be, I can't imagine it. There's going to be so much anticipation leading up to those days. It's going to get crazy. Buckle your seatbelt.
Yeah, buckle your seatbelt. Get ready for it. I mean, it seems like every 4 years we forget that what the environment is like, right? And I like what he said when he was essentially, every single election that we've had is the most important election of, you know, that we've ever had, right? I mean, and we say that every single time. And so, we all kind of forget how crazy it is as we kind of gear up for, you know, these type of election cycles.
Yeah. Any last thoughts before we close this out?
No, I think, you know, back to a few points, and just to kind of sum this up, I really do. I think a lot of this has to do with the long-term aspect of what we look at as advisors, right? And what we look at Beavers Wealth Management. And I think it's once again important to realize, as he started off his conversation with, is that at the end of the day, regardless of what happens, there's going to be opportunities to grow portfolios and for markets to grow over the course of the next 4 years.
Right.
And I think that that's such a key piece of this. And if you combine that with the idea that an actively managed approach during this time is really going to benefit long-term success within one's portfolio. Yeah. I think you merge those two mindsets together and you can really be successful regardless of what we see over the course of the next 30 days. So I thought you did a heck of a job too. So, great job at a wonderful interview, and we are truly looking forward to it. I mean, I know that this is something that we've been very excited about doing, is more of these kind of discussions, right? And so, we listened to clients, we heard from clients, we'd like something more casual where we're talking to different types of people and then getting your input on this. And so I really hope that people enjoyed this type of dialogue, because I think there's a lot of value to be gained from some of this. Yeah, there's definitely a lot to go back and listen through. I think we've got Bryce and I's conversation was about 45 minutes. There's a lot there, a lot of detail. It was a lot of fun for us, but man, we got to get back to work. Yeah, let's do it, man. Look forward to the next time. So appreciate it. Yeah, let's do it.